What did they look at? There's a reason why deals fall apart. Even at, 86%, while that's a good closing ratio, that's still 14 people out of every 100 that wrote a contract, spent money on earnest money, spent money on a home inspection, spent money on an appraisal, that then got their loan denied when they shouldn't have had to do that. Because that means somebody didn't do their job up front to be able to take care of that. We'll do soft pulls on credit if somebody doesn't want to do a full hard inquiry. If somebody's got numbers from another lender, we'll look at them. And, there's times where we've told people like, hey, listen, you're getting a great deal where you're at. Like, unless you're concerned about somebody being honest with you or their ability to close on time, you should stay where you're at.
Okay. That's wonderful.
And technology's really been a big difference. And that's super surprising. And it sounds like it shouldn't be the case when you're a much smaller company. You think the larger company should have better technology because they have more money. But they're so large that they have to try to do their own technology because they can't afford to outsource it because of a per seat cost.
We are familiar with that here in the real estate.
We know all about it.
Yes.
So we've been able to go to companies that's all they do is just that.
Okay.
We're just paying per seat. And so that technology has been way better. But technology is, while it's super important, it's only important if you can put it together with a personal touch.
We go behind the scenes of the lending industry in today's episode with Mike Garrett from Strategic Mortgage Advisors. Mike offers a unique perspective on the ideal buyer's mortgage journey and emphasizes the essential need for a seamless partnership between agents and lenders. This discussion provides real estate professionals with the critical insights required to enhance client service, covering everything from operational differences between brokerages to the reality of interest rate trends. With over 20 years of experience in the financial sector, Mike is a highly decorated professional holding diamond and platinum awards from the Mortgage Bankers Association. Known for his commitment to excellence, Mike merges deep industry expertise with a sincere passion for helping others. He focuses on making the loan process as efficient and stress-free as possible, ensuring client comfort remains a top priority throughout the transaction. This is Mike Garrett. Hello and welcome to Pro Talk by Atlanta Communities. I'm one of your hosts, Tony Stevens, and I'm here today with my colleagues, Mr. Mark Hall and Mrs. Natasha Bruce-Krantz. Welcome. And our special guest today is Mike Garrett with Strategic Mortgage Advisors. Welcome, everybody. Thank you for being here today.
Thank you. Thank you.
Yeah, we're glad to be here. Wonderful. And Mike, tell us about Strategic Mortgage Advisors. What made you start the company? What were you trying to do differently? Let's go ahead and get into it today.
Yeah, so we've been almost 2 years since we officially opened. It'll be 2 years later this fall, but the idea kind of started a little over 2 years ago, and it really revolved around seeing how much things had changed in the retail lending space from a standpoint of overhead, and that cost had to come from somewhere, and it was coming from the consumer.
Okay.
In forms of higher rates and higher closing cost. And so we set out to do this to pass along those savings to the consumer. So we have very little overhead. When I was working for retail mortgage companies, a lot of that, is we would close a loan. Mm-hmm. There's 6 or 7 people above that are earning a paycheck off of that loan.
Oh, wow.
And that money has to come from the consumer.
Okay.
And so it gets passed along. And so we've been able to cut out those things. Opening it was super hard. Not going to lie. It was way harder than I thought it would be. But
Sure.
I would do it again in a heartbeat if I had the opportunity. It was very rewarding. Learned a lot going through the process.
Right.
And it's really, the savings that we've been able to pass along to the consumer have really come to fruition of what we thought would be the case.
That's wonderful.
And technology's really been a big difference. And that's super surprising. And it sounds like it shouldn't be the case when you're a much smaller company. You think the larger company should have better technology because they have more money. Mm-hmm. But they're so large that they have to try to do their own technology because they can't afford to outsource it because of a per seat cost.
We are familiar with that here in the real estate.
We know all about it.
Yes.
So we've been able to go to companies that's all they do is just that.
Okay.
We're just paying per seat. And so that technology has been way better. But technology is, while it's super important, it's only important if you can put it together with a personal touch.
Of course.
So that's, what we really focus on and trying to put those together.
Excellent. Well, congratulations on 2 years. I know Mike has been part of the Atlanta Communities family for many years.
2008, so 18 years now.
Wow. Holy cow.
Yeah, we used to eat Taco Bell.
Yeah, 2009, we had Taco Bell.
And occasionally Costco. Yeah, occasionally
Costco. When Taco Bell was still 99 cents for stuff. It's not anymore, but,
right.
I don't know that it really saves you any money anymore. But
right.
It's back then I had a Costco membership just to go eat lunch. I didn't buy anything in bulk. I just went and ate lunch.
We were all familiar with what the market was like in 2008 and 2009, weren't we?
Still got some scars from that.
Yes, for sure.
Yeah.
Definitely balls and strikes.
100%.
Yeah. Right.
Yeah, a lot of extra things going on.
So okay, so now we know what the company does. So how does being a mortgage broker differ from being just a regular loan officer for a company? What makes that different, and how is that better for Atlanta Communities real estate professionals than doing it the other way?
Right. So when you're at a large retail company, so you've got multiple different options from a standpoint of lending. So you've got a bank, which is just an FDIC institution. They do checking, savings, and then they also dabble in mortgages. But they're generally not going to be the best. They take a little bit longer. They've got lots of other things that they do.
Mm-hmm.
And then you've got retail companies, which are large independent mortgage banks that, all they do is just mortgages. And so all they have are what their products are and what their rates are. And they're stuck with just that. And so as a broker, we're able to go to a lot of different companies in the wholesale market. And one company may be super busy at that point and they may raise their rates because they can't take on any more business.
Interesting.
And somebody else may be needing business because they've got to keep their underwriters busy, their closers busy, so that they're not losing staff.
So they throttle
their rates down a little bit, and so we're able to take advantage of that.
Mm-hmm. I guess on the real estate side, we never see this angle.
It's a different perspective of how the rates move in and out.
Okay.
And companies will try to, they'll lower rates because they need more business, or they'll raise rates because they can't afford to take any more business right now.
Okay.
And so that's been a huge deal. But in full transparency, I think one of the things that a lot of people talk about that are on the broker side is they talk about that like brokers are always better. Well, if you're a mediocre broker, you're not better than a really good retail lender. It's just, you're not. You'd like to think that you are, but you're still just mediocre. Just because you have more products doesn't make you better. It just helps the consumer if you're also better doing that. So I think that's, one of the things that we really focus on is trying to put all of those things together, the communication, the technology, the products, the pricing, and bring all of those things together for the consumer and ultimately for the real estate agent to be able to have their clients better taken care of.
All right, so let's get a little deeper in that. So if I did an application with Strategic Mortgage Advisors, and you took the application, or one of our other loan officers took the application, that's being processed here locally by Strategic Mortgage Advisors, and then sent to whoever the second.
Correct.
Right.
So so how we handle it is we're going to process everything, and then we're going to send it to an underwriter that's going to be done somewhere.
Okay.
And most of the time that underwriting. So one of our largest lenders, they're the largest lender in the country, United Wholesale Mortgage. And if I send a loan to them right now, 11:15 on a Wednesday, by 3:00 this afternoon, I'll have underwriting approval.
Wow.
So that's 4 hours. So that allows on the real estate side, if you're thinking from a standpoint of trying to make your offer more competitive, now if you've got a 3 or 5 day due diligence, you can essentially put 0 days on a financing contingency because the financing is going to be done inside of the due diligence. So you don't need that separate financing contingency because the financing is going to be done inside of due diligence. And so now your offer looks stronger to the seller.
Absolutely.
So that's
a big deal.
One of the biggest things that have really been, amazing. And so if you back up, we were talking 2008. And so prior to 2008, brokers were a huge part of the mortgage industry at that point.
Right.
And they kind of went away after 2008. But over the last few years, they've really started to make a big push back because of the same reasons why we opened this, because of the large overhead at some of the big companies.
That's a big deal. And again, I don't think most of us know those inner workings of it and why that's important and how it ultimately translates to buyers in the marketplace,
Right.
in terms of savings and everything else.
Each company, they talk about, when you're at a retail place, they talk about, hey, how do you sell against a broker? Like they don't control anything. Well, we still control a fair amount. In fact, we actually probably control more, because if this lender says like, hey, we don't like this, well, then I can go to this lender and do it.
Right.
But if I'm at a large retail place and that underwriter doesn't like it, I have no other option.
Nowhere else to go.
Done. I have to then let the client go somewhere else and figure it out on their own. I can't do anything about it.
Okay.
But in the broker world, I can then move that loan to a different place.
And does that usually translate into better rates, et cetera, for Atlanta communities?
Because they have to compete. Those wholesale brokers, they have to compete, and they have to provide a good service, because they know that I have options to take those loans to. I can take my clients to 50 different places. And so if company A is not doing a good job, then they know I don't send any more business there. I can go somewhere else. Versus on a retail side, they know that I have to send my loan to them. It's where I work. It's the only option that I have.
Right.
And with the remote work, it used to be back in the day, people would be like, oh, your loan's going to be underwritten here locally. Now, nobody can guarantee that. You've got employees all over the country. It doesn't matter. Your corporate office may be here in Atlanta, but your underwriter that's underwriting the loan may be in Kentucky, or Colorado. It doesn't mean that just because your office is here, all your employees are here.
Yeah, if you're talking about like submitting a loan today at 11 and getting an answer this afternoon, that's a big deal, no matter where they're sending it.
Absolutely.
Yeah.
It's, and it creates a lot of things that, products and special things that they'll run. Like right now, one of ours is offering, they're covering a 1-0 buy down. So, it's, so different things like that ultimately help the consumer, in getting into the home.
So can you expand on that a little bit for our audience that may not understand what that 1-0 buy down is?
Yeah. So if, let's say the current market rate was 6.5%.
Okay.
That first year, your interest rate's now 5.5%.
Okay.
And there's no cost to you to do it. So we're covering that cost. And so there's different things like that we'll run all the time. And those things are always available.
Okay.
But most of the time it's paid for by the seller through seller paid closing costs, or it's paid for by the lender in exchange for a higher rate. But right now we're just running a special where we're just covering that cost. And so it's been a big deal for, people, especially when you're a first time home buyer and you're going into that first year. That's generally always the most expensive, because you've got to add some different things. You got to add some furniture. You got to go buy a grill,
right?
Some window coverings, different things like that you may already have if it's your second or third home.
A grill. Of all the things you could have picked, a damn grill.
You got to have a grill.
Right. Well, I guess so. Right?
You want to invite people over?
Yeah.
Have a cookout.
I guess so. I just get it catered in or whatever. Right.
Well, but
lazy.
you're not a first time home buyer either. But yeah, that first year for a first time home buyer, you're trying to come up with your down payment, right? You got to have your down payment. You've got your home insurance, moving expenses, all in, as you said, all the
new
things
stuff,
all the things.
Right.
Well, thank you. I'm sure that's very helpful for folks that were not.
One question about that. So with the lender paid buy down on that program, does that also, I know this, but can that be added to, in other words, could they do a 2-year buy down if somebody else funded the other year?
So no.
Oh,
so
interesting.
Not. So it all has to be paid for by the same person. So,
oh, really? Okay.
Yeah, so you can't split it up, unfortunately.
Oh, that's very good.
You would think that you would be able to
qualify the lower rate at the start rate for year 2. Okay.
Yep.
Okay.
All right, so I have a question for you.
Yes, ma'am.
I know everybody wants to know what's happening with interest rates.
Okay. Yeah.
We know we've got economists out there that have their predictions. I know you don't have crystal ball.
Yeah.
But what do you think where we're going? Are we just going to stay where we're at?
So let's kind of talk through a couple of different things on that. So
let's talk about refis. No, I'm kidding. Yeah.
So I think that, if we back up, roughly 90 days ago, we were much lower interest rate wise at the end of February. And pretty sure the exact date was February 27th. At the end of February, we got involved in the Middle East again, and that sent rates up. And it was all based on the fear of inflation going up, which was rightfully so, because oil prices have gone up. We've seen everything get more expensive over the last 90 days. And As we're filming this, that is all coming to an end. Hopefully, there's framework in place, and they're supposed to be signing on Friday. So hopefully, by the time this airs, all that will have done. We also, today is day 2 of the Federal Reserve meeting with the new Fed chairman, Kevin Warsh. And so there's a lot of unknowns and uncertainties. His stance is very different from his predecessor. One of the things that I think could be very good in allowing the market to really just react to more data and not speech is he believes that the Federal Reserve members should speak a lot less and not be involved in putting, talking points out there to the media and to the markets, and that they should just, act with more, purpose instead of speaking about things. And so that'll be interesting to see. As far as rates itself, so it's interesting how much things have changed since the first quarter of the year. So at the end of the first quarter, it was pretty unanimous that between NAR, MBA, Fannie Mae, National Home Builders Association, all of them felt rates at the end of this year would be kind of high 5s to low 6s.
Yeah.
Fast forward after everything in the Middle East, and now almost all of them feel rates will be 6.5-ish at the end of the year, which is about where they're at right now.
Okay.
So, in fact, some of them feel that rates will stay. So the Mortgage Bankers Association feels rates will stay in that 6.5 range for 26, 27, and 28. No change. I think that they've missed so much on forecast over the last few years that I think now they're getting overly conservative on where they think rates will be. I personally think that on government loans, and government loans always have lower interest rates than conventional loans. And so I think on government loans, we'll see low 5s later this year. Right now they're, mid 5s to 5 3/4. So I think we'll see low 5s, and I think we'll see conventional loans, right around 6% flat. Maybe a little under given, a specific borrower situation. But I think it'll be around 6%.
Gosh, my first house that I bought was a 6.5% interest. So we talk about this, and of course, the people who've entered our real estate agents that entered the market during the pandemic. Gosh, over the last 10 years, really, the numbers have been so low. Us coming up back into the
6s is a big, yes, that's a big deal.
It's where it really should be.
What I always explain to people when we talk about it, because you'll get people that will say, well, I'm just going to wait for rates to come back down. And I say, okay, well, come back down to what? And they're like, well, I'd like to see rates in the 3s. And so if you think about it from how mortgages work, and it's based on the trading of mortgage-backed securities on Wall Street, and it kind of follows along with the 10-year Treasury. But if you just break it down very simplistic, if I came to you, Natasha, and I said, hey, I've got this great deal for you. If you buy this security, I'm going to pay you a 3.5% return over the next 30 years. And you have that type of money, you have financial sense to know, well, the S&P's kind of returns about 10% per year. Why would I buy this at 3.5%?
Right.
No investor is going to do that. The investor that did it was the United States government. And that was done through quantitative easing, and it pushed interest rates way down to spur on the market. We were seeing rates go up, and then COVID happened, and they panicked, and were like, we got to do something. And it drove rates right back down even lower. And so without the government buying mortgage-backed securities, which I think is even less likely now because the new Fed chairman, his belief is that the balance sheet should be much smaller than it has historically been. And so you rely on the private sector to be buying those. And so you've got to be in that 5.5 to 6% range to get
people to buy it. Sure.
Because otherwise they're not willing to take the return on it. And I don't blame them, And so most of the time when I explain that to the buyer, they're like, well, yeah, I wouldn't buy that either. I'm like, okay, well, then, you're waiting on something that you yourself said you wouldn't do. So somebody else isn't going to do it either. So it really decreases the chances that that's going to happen. And if it does, all you're going to see is a massive run up on home prices again,
Right.
which is not good either.
No, it is not.
We don't need that to happen either. I mean, while as a homeowner, I love for interest rate or for home prices to go up, but it's not, going to be ideal for everybody, and it's just going to drive the cost up.
Yeah, only if you're staying put.
Correct.
Right.
Because if not, you got to take all the money that you may be gaining at that property and then move to the next property. And what do you got to do? You got to pay more money.
I think, to that end, one of the things that that drives, and this may be a sore subject with some of our audience, because I know that plenty of people use this phrase, but I think one of the most overused phrases over the last few years, I think was awful, was marry the house, date the rate.
Uh-huh. Yeah.
And so I think it's, how many people bought 3 years ago and were told that and are still in that exact same mortgage?
A lot of folks were told that.
Yeah. And so I think it's one of those things, like if rates come down, then great. You can see a lower payment, but you need to be comfortable with the payment of the house that you're buying right now, because there's nothing guaranteed in the future. And so you can't buy assuming that I'll tough it out for a year, but I really need this to come down or I'm not going to be able to afford it long term.
Yeah.
That's not a good strategy.
No.
No, not at all.
No.
Not at all. You need to be able to afford it for this year and the next 15, 20, or 30 years, whatever,
And have
whatever
a
the
little
client.
cushion, because
Yes.
Well, that's back
go
to
up, homeowners
Absolutely.
insurance goes up.
Yes.
that's back to LIBOR, and all of a sudden it moves, and everybody went, "Oh my gosh!" So then your payment doubled, and people weren't prepared for it.
Yeah, for sure.
Yeah.
You touched on something a moment ago, talking about government loans. For the audience that may not know what those are, could you just let us know?
Yeah. So you have government loans, or FHA,
Mm-hmm.
backed by the Federal Housing Administration.
Yes, sir.
VA, Veterans Administration, have to be a veteran,
Mm-hmm.
and then USDA. So USDA, rural housing, you have to make below a certain amount based on your income or your household size. But what's interesting on it is it's not everybody that's just on the loan.
Mm-hmm.
It's everybody in the house. Their income counts whether they're on the loan or not.
Oh, really?
And so
I didn't know that.
So if you've got, a married couple that's buying a house and you're just having one of them on the loan, the other one's income still matters and can put it over the limit. And so it's kind of rural areas, there's nothing in Cobb County. There is some in Northern Cherokee, Bartow, Paulding. There's some areas around us in the metro area, in the Atlanta MSA, that do qualify. And there's no down payment required. It's got super low mortgage insurance. So it's a really good loan program. VA, there's no down payment. And so it's a great loan for our veterans.
Mm-hmm.
And then FHA is a 3.5% down payment. And I think one of the biggest misnomers is people think that FHA is for first-time home buyers.
Okay.
And with where the rate differences are, because they typically have lower rates than conventional loans, you may have a 700, 720 credit score, and the FHA loan's a better loan for you payment-wise and down payment-wise than doing a conventional loan.
Okay.
And so I think a lot of times people go in and they think, oh, well, this is an FHA. The borrower is not as well qualified. They might still qualify for a conventional. It just doesn't make sense to do the conventional because it's $100 a month less on the FHA and they save $3,000 at closing.
Makes sense.
Just let them do the loan that's going to make the most sense for them financially. That's going to help housing long term.
Okay. Thank you.
Oh, so sorry.
No.
On the FHA, what is that limit now? What is the sales price limit?
Oh, goodness.
Or loan limit, or however it goes. Yeah.
It has.
Which has been a good thing.
Mm-hmm.
I will tell you, I don't know off the top of my head. It's because they change every year.
Sure.
And so it is way higher than you would think.
It is.
We will have the answer and link to it in the show notes. How about that?
Yes.
Yeah, for sure.
Yeah. A conventional conforming loan. So conventional means anything not government. So it could be a jumbo loan or conforming. Conforming meaning that it's below the jumbo loan limits, meaning that you can go to Fannie Mae or Freddie Mac with that loan. And so, those are in the 800,000s at this point. And I remember forever, many of us do, like it stayed at 417,000 forever.
Mm-hmm.
And then the increase was to 424,100 forever. And now fast forward and it's well over $800,000. So meaning that you can almost buy a $900,000 home if you were a first time home buyer with a 3% down payment.
Okay.
Wow.
It's incredible.
Yes, it is.
But when you look at home prices, like,
Yeah.
you know, they've gone up there a good bit.
I
So
want to live in Macon. Go right ahead.
exactly. Yeah, for
Right.
sure.
So, elaborating on that, so what are some things or something that Atlanta Community's real estate professionals need to know about the lending world that would help their clients specifically in whatever aspect?
Yeah.
I mean, I know you've covered some of that, but
So one of the things I think, and we'll talk on this one first, since we just talked about, government loans, is this always baffles people when you see these numbers. But so I'll ask you guys kind of the questions of what you think. So, and this is based on 2024 HMDA data on closed ratios of loans. Okay.
All right.
So talking about conventional loans, FHA loans, and VA loans. Which loan do you think, or do you think most people believe, closed at the highest rate of those three types of loans?
I would have thought conventional.
I would agree.
Okay. So VA closed at the highest rate
Really?
at 91%.
Wow.
And if you were to ask most people, they would say, in order, I would rather take a conventional offer, then an FHA offer, then a VA offer. And VA closes at a higher rate than any other type of loan.
That is shocking.
wow.
The second highest is conventional at 86%. So
Okay.
meaning that for every 100 deals, 5 more VA loans are going to close than 5 conventional. And so then FHA is at 84. So conventional or an FHA are very close.
Very close.
2 apart. And one of the things that I think is a big talking point when it comes to real estate agents on VA is appraisals. They always complain about the appraisals.
Mm-hmm.
And so one of the things that I always like to point out is on an FHA and a conventional appraisal, if the appraisal comes back low, I have to convince the appraiser that did the report that he or she is wrong. How likelihood it is that we convince somebody they're wrong? Not very good, especially
unlikely.
when they're the ones that are supposed to be the professional in that, and
Right.
you're not.
Correct.
So now I have to convince them they're wrong, which doesn't happen very often.
Mm-hmm.
On a VA, they first issue what's called Tidewater, which means they're having a hard time meeting the values. They're asking for help.
Okay.
You then supply that data. And I would tell you, based on my personal experience, 80% of the time, it's still then not going to come in at value if they've invoked Tidewater. It does come in at value sometimes.
Okay.
But most of the time it doesn't. But once that's done, the appraiser's at it. And now we get the report.
Mm-hmm.
We can type up a letter. We can send our rebuttal points, and we can send that to the VA, and they have another person that can then change the value.
Right.
Interesting.
So it's not the appraiser. The appraiser's
Okay.
out of it. Once
Okay.
they finish their report, they're done. They have nothing to do with the value gets changed.
Okay.
It's another party at the VA. And I would say just flip it. It's about 80% success rate that we then have them able to change the value. And so
That's wonderful.
more often than not, you end up getting to the value where you wouldn't have been able to do that on an FHA or a conventional.
You just changed my mind on VA.
So it really is, if you were to really look at everything that goes into a VA, it's the best qualified buyer because they take into account, okay, what's typical maintenance for a 3,500 square foot home? What's the typical maintenance or living cost if you've got a family of 4? All these different things that they look at to make sure that you qualify for the loan versus just, here's your debts. Doesn't matter.
Interesting.
And you and your team at Strategic Mortgage Advisors can handle all of these scenarios.
Yeah, so we handle VA, FHA, USDA, conventional, jumbo, and then you have what's called non-QM loans, which are non-qualified mortgages.
Okay.
And so those are loans that, you use 12 months of bank statements for somebody to qualify. You have what's called you'll hear it referred to as a DSCR, but it's a debt service coverage ratio loan.
Okay.
And it's for somebody buying an investment property, and they don't have to show any income documents. The whole qualification is based on what's the mortgage payment going to be, what's the rent going to be. And as long as the rent is going to be what the mortgage payment is, and sometimes it can even be a little less depending on down payment and qualifications of the buyer, but most time you want it to be the rental or more, or the mortgage payment or more for the rent, then they can qualify just based off of that. So you end up closing that deal with just appraisal, title, and homeowners insurance and assets, and that's it.
Okay, so I'm going to jump on out there. Obviously, I've got my strategic mortgage advisor's cap on. So why isn't everybody getting their loans through strategic mortgage advisors?
It's a good question.
It is a damn good question. I thought it was like cutting right to the heart of the matter, right? What the hell?
Yeah.
What's the matter with people?
I think we're super proud of everything that we've done. We take great pride in making sure that our pre-approvals are well done and put together. And to me, that's one of the biggest things for real estate agents to know. If they don't already, most of them do, but not every pre-approval is the same. Because at the end of the day, the pre-approval letter itself is worth this, right?
Sure.
Because what really matters is who put it together. What did they look at? There's a reason why deals fall apart. Even at 86%, well, that's a good closing ratio. That's still 14 people out of every 100 that wrote a contract, spent money on earnest money, spent money on a home inspection, spent money on an appraisal, that then got their loan denied when they shouldn't have had to do that, because that means somebody didn't do their job up front to be able to take care of that. And nobody's perfect. You're going to have things that change. Somebody loses a job. Somebody wasn't truthful on everything up front. Those things happen. But going through and looking at all those things matters. What we tell our loan officers is, as a loan officer and as a company, we can be one of two things. We can either be the reason why our client's offer gets accepted, or we can be the reason why their offer doesn't get accepted. Because every deal that we do impacts all of our future clients, or has the ability to. Because if you're on the listing side and we've done a poor job, whether it was through communication, we missed a closing date, we didn't close at all, and now you get another offer, and you've got multiple offers, and ours is one of them. You're going to tell your client, like, hey, we've worked with this company before, it doesn't go well.
Yeah.
And now that client didn't get the house because they chose us as a lender. That's not acceptable. And so the opposite side of that is the listing agent says, hey, I've worked with this company and this loan officer before. They do a great job. Numbers are close. This is who I would go with. And most of the time, your client then listens to you. And so to that end, so talking about clients listening, one of the things that I think, really drives, the relationship is really being in communication with each other. But what I have found that works best for real estate, referrals is having that conversation with a client from a standpoint of who they're going to use for financing. And you don't have to require them to use anybody,
right?
Or should you require them to use anybody? But your conversation should be, listen, you've hired me because you trust me. And I'm telling you that if I were getting my loan tomorrow, this is who I would use. You're free to use whoever you want, but you've hired me because you trust me, and I'm telling you I trust this person. Most of the time, your client at that point will say, okay, that's who I'll call.
Right.
And it's that simple.
Yeah, and I know because we've obviously been together a long time, relationships matter, and relationships make a big deal. And the good news for everybody is that relationships do indeed matter. Right. So taking that into account, the fact that they have relationships with other loan officers, not strategic mortgage advisor loan officers, but those people, then all really anybody can ask for is just give you a shot about. That's right. You've got loan officers at every
office, but in town.
Okay. And so we have at least six loan officers, and just give them a chance.
Yeah.
Okay.
And we just recently added another loan officer to West Cobb. Super excited about her. She's really fantastic. And she's from Columbia, is fully bilingual, really experienced in mortgages, and is going to be a huge help to our Spanish-speaking realtors.
Wonderful.
It's going to be a big deal for us.
And the majority of your team has been with you for a long time.
For a long time, yeah. So one of our processors has been with me personally for 12 years now as a processor.
Okay.
We've had several of our loan officers that have been with us for 4 to 5 years.
Yes.
So it's been a really good deal.
Excellent.
I think, one of the other things that I would talk about from a standpoint of what real estate agents should know, and this is going to be a different mindset to think about. And so I'll kind of ask you the same question that similar type question to what I asked earlier. But so if you've got two buyers, conventional offer, one's putting 20% down and one's putting 5% down, who's the better buyer?
Typically, I would say the 20%.
Right? That's the common sense wise, that's what says should be correct. Right. So I would encourage real estate agents to think about this differently. So if you're on the bank side and somebody's going to give you 20% and you only got to own 80% of the value of the home, do they have to be stronger? Or does the buyer that you've got to loan 95% have to be stronger? My risk as a bank is much larger if you're only putting 5% down.
Right.
So now you have to be a stronger buyer from a standpoint of ratio, debt to income ratio. So your income and your debts, your credit score. There's many a times that we get somebody that applies and they're like, I can only do 5%. But we tell them like, I'm sorry, I can't get you approved with 5. But if you can do 10, I can make it happen.
Interesting.
Well, that buyer didn't become stronger. They're still the same buyer. They weren't strong enough to buy with 5%. So the only time that extra cash can really come into play is if you were to have an appraisal situation. But outside of that, the seller's getting all their cash that day anyway.
Well, plus a
combination from whether it's all from the bank, all from the client, they're all getting that money that day, regardless of where it's coming from.
Well, the idea of other people's money. I mean, again, if you have the 5%, you may have other assets and other money that you're not putting in there, right?
It may be earning you more money.
Absolutely, right.
You're going to do a lot of renovations to the house and you're going to save that cash for those things. And if you just talk on return on investment, and I know that this is oversimplifying it a little bit, but if you just use a standard $400,000 purchase price and you put 5% down, well, you've put $20,000 into it. If over the next 3 years, let's say we use a 3% return every year. So now you're roughly, we won't talk about how it, it's going to be a little bit more because of the 3 plus the 3 plus. But over that time, each year you've made roughly $12,000. So your $20,000 just made you $36,000. Okay. Well, if you put $80,000 down, the home value didn't go up more. Your $80,000 made you $36,000. So which one's better? $80,000 making you $36,000 or $20,000 making you $36,000? While the other 54 is making you other money somewhere else.
Right.
Yeah, I think there's a lot, and that's interesting you say that and bring that up because I do think there's a lot of misconceptions about it. And given the number of people that have entered our industry and whatever time frame you want to use, whether that's 5 years or 10 years or whatever the time frame is, now if you go back and start looking at that, because I don't think that historically we probably were not as fixated on how much are they putting down. In other words, cash at one point, we typically have people that were in the market to buy houses putting the least amount of money down. And so we looked at that and didn't think anything about it other than can they qualify?
Right.
Because again, to the seller is all cash.
Correct.
They don't care.
Yeah, you're getting all that money on the closing anyway.
Sure.
I did mention appraisals. And so I'll quickly tell you, because a lot of times people think that, okay, you have an appraisal that comes back low. And we haven't had appraisals come back low in a while, really. You may get one occasionally, but it's been a few years since we've seen that. But there's always that possibility. And so the natural inclination is, okay, appraisal came back low, buyer's got to write a check for the difference. And that's not always necessarily the case. And so that's where that cash could make a difference is if that happens. But we had one where this was a few years back during COVID when things were a little crazier, obviously. But they were putting 10% down, and the appraisal came back $30,000 difference. It was about a $600,000 deal. And so we changed their loan to value from 90 to 95%. And the seller lowered the price by like $3,000. It was $30,000 different. They only cut $3,000 off. And we used that money, and the buyer then paid an upfront mortgage insurance premium to buy out some of the mortgage insurance. And so when they walked away at the end of the day, the seller lost $3,000.
Okay.
The buyer spent an extra $1,000, and their payment was the exact same. And the appraised value was $30,000 less.
Wow.
And so that's just structuring things differently and not just thinking, well, somebody's got to write a check for the difference.
Yeah.
Not necessarily. There's ways to structure it to make it work for everybody.
And that's exactly why people need to be using strategic mortgage advisors.
Absolutely.
Yep. Or
Well, I mean, that's true of any transaction. You've got to figure out what is best for the people involved and then work on that premise. And I don't think buyers, and this is a topic for another day, but I don't think buyers should enter into a transaction thinking the damn thing's not going to appraise.
No.
And yet, sometimes they do. And sometimes that then comes to fruition. You know, what are you doing to help that? And how are you structuring the transaction? And what are you doing on the front end? And this is true of listing agents as well, you know?
Yeah. One of the things that we're trying to push for, and, you know, we'll see how many people take advantage of it, but it's something that's important to me right now because I feel like it will make the process better for everybody. So we're trying to implement it, is really push for, after we do a pre-approval, I know people have busy schedules, but to schedule a time to where the loan officer, the client, and the realtor are all on a call together, and to really plan and put together everything that's going to help the client, and to go through it so that it's not, you know, hey, call and ask them this, call and do this.
Right.
Let's just all get on a call for 10 minutes.
Get together as a team.
And we're all working together.
Right.
And so let's talk about it together.
It's a great idea.
And to try to, you know, make sure that there are no questions, and to go through, you know, what's the best situation. You know, like we had a deal that we were putting together yesterday, and, you know, originally the idea was, hey, let's do $10,000 lower on the asking price and ask for $5,000 in closing cost. And I said, okay, we can certainly do that. But what if we instead say, let's just do the normal purchase price and ask for $15,000 in closing cost? We can use that money to save you some cash as a first-time home buyer and to lower your interest rate. And now your payment's lower and you need less cash than if you had done it at $325,000 and $5,000.
Sure.
You know, now all of a sudden, you know, the seller's going to get the same amount of money regardless. And the buyer's in a better situation, and just structuring it differently.
That sounds like maybe that factored into the name, Strategic Mortgage Advisors, not Strategic Mortgage, whatever.
Right. Yeah. We really try to, you know, take a full look at everything and not just, okay, here's your rate.
Yeah. So it's not one size fits all.
Correct.
It's very customized for each individual and what they're looking at achieving.
Absolutely.
One size fits one.
One size fits one.
Yeah.
I love it. That's great. I love that.
All right. Well, we're going to put a wrap on this, Mike. Thank you for being here. We always ask our guests 2 questions to end the podcast. And I'll start with the first one, Natasha, if that's all right. What is your favorite book or podcast that you are either listening to or reading? Could be this year, last year?
I have 2 on podcasts.
Okay.
I mean, one's Pro Talk.
Awesome.
Thank you, sir. I mean, that's number 1. And then number 2, to me, is the Ed Mylett show. I love Ed Mylett. He's one of the, you know, great speakers, you know, and one of the things that he talks about, one of his great quotes that I use in lots of different areas of life. But when he talks about it, he's talking about his dad.
Okay.
And he talks about his dad, and he asks his dad, like, Dad, are you going to quit drinking for the rest of your life? He said, I don't know. He said, but I can tell you I'm going to quit for one more day.
Okay.
We can do anything for one more day.
Sure.
But when you think about, I got to do this for the rest of my life, that becomes overwhelming. And
Yes, it does.
One more day, though.
One more day, you can do anything for one more day.
Sure.
Right.
And so you can apply that to so many different areas of life. Of, you know, are you going to give up on your business? Business has been tough, right? Are you going to give up? Or are you going to say, no, I'm going to do this for one more day? And then that day turns into another day, to another day, and, you know, make one more phone call, make one more text,
right?
Send one more email, make one more video that you post,
right?
You know, it's just do something for one more day and just keep piling on that, and it'll eventually work out.
Excellent advice. That's Ed Mylett.
Ed Mylett.
Okay.
Yep.
Thank you.
Yeah, I like that. And then our last question is, if you could have dinner, lunch, a drink, anybody past or present, who would it be and why?
So I think right now, mine would be a guy by the name of Dan Martell. probably not widely known by tons of people, but he wrote a book called Buy Back Your Time, and it's goes off of kind of like a 95-5 principle. And I think it's something that we can all apply. And he's really big right now in the AI space and putting stuff together, but has also written several books. But, it's figuring out, like, as you're building a business and building a team, what should you really be doing and what should you be having somebody else do? And so at the end of the day, the most successful people, I believe, are the ones that figure out, like, this is what I'm great at and this is what I love, and that's what I'm going to do. And everything else, even if I'm great at it, if I don't love it, I should probably have somebody else do it.
I like that. Yeah, me too. So I'm going to challenge everybody to reach out to the Strategic Mortgage Advisors loan officer.
Absolutely.
Yeah. Just to have a conversation, just to get to know them, just to make sure that you are talking to them and to see what options that the buyers that you work with might find different.
Yeah. And we are happy to help in any way. We take everything into account. Like, we'll do soft pulls on credit if somebody doesn't want to do a full hard inquiry. If somebody's got numbers from another lender, we'll look at them. And, there's times where we've told people, like, hey, listen, you're getting a great deal where you're at. Like, unless you're concerned about somebody being honest with you or their ability to close on time, you should stay where you're at.
Okay.
And we believe that if you're honest with people and you treat them fairly, even if you're not the one that did their loan, they'll tell other people about it.
Sure. Of course.
100%.
That's all that it matters is, our goal every day is to help somebody else, whether it's a real estate agent, whether it's a client, and they would then tell somebody else about us.
All right. Well, Mike, thank you so much for being here. All the great information. Thank you for everything you and your team do for Atlantic Communities and all of our agents and clients. We really appreciate the partnership that we've built here over the many years.
18 years, and I'm super excited every day about it. I love the partnership with Atlantic Communities. So many great realtors that are here, so many great leaders at Atlantic Communities, and it's really a great organization, and we're super happy.
Thank you, sir. Thank you, Mark. Thank you, Natasha. And audience, we will see you next time on Pro Talk by Atlantic Communities. The views and opinions expressed on this podcast are those of the hosts and guests and do not necessarily reflect the official policy or position of Atlantic Communities Real Estate Brokerage. Content shared is for informational and educational purposes only and should not be considered legal, financial, tax, or real estate advice. Listeners should consult with their own licensed professionals before making business or real estate decisions. Atlantic Communities Real Estate Brokerage is an equal opportunity employer and supports the Fair Housing Act.